I've made almost $250,000 across 2 crypto bull runs, but I could have made so much more if I would have just followed 7 simple rules. 7 rules that you must understand if you want to enter the top 1% of crypto investors. And this is outside of the things that we already know. Dollar cost averaging, invest what you're willing to lose. Put the majority of your portfolio in Bitcoin. All of these fundamentals still hold some truth, but despite so many people doing these, the majority of people that invest in crypto are still losing money. And that's because the truth to building wealth with crypto is hidden in the sudden details, some of which are unpopular or even uncomfortable at times. But as for which one is the most important, I'm leaving that for you to decide, because so many finance videos on YouTube are cookie cutter when in reality, I don't know you and I don't know your circumstances. The only 2 things I ask is that you actually take and apply these rules, and then hopefully at the end of the next bull run, when you're sitting on your own $250,000, you let me know which one was the most beneficial to you, and that you like this video, because I would really appreciate it. The first rule to understand to be in the top 1% of investors is that you have to beat the other 99%. Investing is a zero-sum game, meaning that in order to make money, someone else has to lose. Last bull run, I made a $5,000 investment that ballooned to over $330,000. So over a 60x on my money. But the harsh truth is that this company didn't actually increase the value it was bringing to the market by a multiple of 60, but 60 times more investors decided to invest in the company. This means that everyone who bought into this company after me at a higher price would be losing money if they were to be selling to me. That's where the money I make would come from. But by understanding this rule, we can see what the other 99% of investors are doing and do the opposite. This is called inversion thinking, and it's built on the premise that our brains are better at identifying problems than finding solutions, and it's the foundation of which the other rules will stem from. And what a majority of people don't understand is that yes, it is important to be able to identify good projects early, but what's even more important is understanding the rule that a large amount of wealth created in crypto is actually just created out of convenience fees. For example, look at the project Shiba Inu. This coin was listed only on a small handful of marketplaces between late 2020 and early 2021. And these marketplaces were not easy for crypto users to use. Sometimes you had to use a VPN because your country may not be allowed, or possibly extensive identity verification. But I know a small handful of guys that put between $15 and $50 a piece, and they made between $15,000 and $50,000 respectively. And even last bull run, I spent a half a day trying to get verified on this one exchange that I wanted to get into on a particular project. Yes, I had to spend a half a day, but I was able to turn $1,000 into $10,000. So not bad for a half a day's worth of work. And that's why it's imperative to look at these obstacles as opportunities, because of what potentially awaits on the other side. And not everyone is going to want to be able to do this. But just because you get into a successful project doesn't guarantee a good outcome. Something many of you are aware of is dollar cost averaging, or just steadily buying your favorite cryptos over a certain time period. Now, this is something actually promoted in traditional finance, and it was made famous by Warren Buffett. But what I don't see a lot of people talking about is when to stop dollar cost averaging. Crypto isn't like stocks where if you wait long enough, most of them end up bouncing back over time. Over the course of 2 bull runs, I've seen many cryptos that have never recovered from their previous all-time highs. This is why we need a rule of when to stop dollar cost averaging. And this is something that I don't see a lot of people on YouTube discussing, and something that I've personally been guilty of in the past, where you end up not only dollar cost averaging into these lower price points, but you end up dollar cost averaging and buying these cryptos all the way through their all-time highs, and it negates a lot of the profits that you could have made. Now, to counter this, I have a specific timeline of when I will stop investing into certain cryptos. So the last bull run, Bitcoin hit almost $70,000. So I think a 50% price increase up to $125,000 is a very conservative price point for Bitcoin to hit come the next bull run. That being said, I will probably stop dollar cost averaging into the top 200 coins when Bitcoin is around 50 to 60K, and the rest of my funds that I end up wanting to invest will be into smaller projects that have a little bit more room to run as the bull run matures. But this rule is going to confront us face to face with the biggest threat to our portfolio of every everything, and that's ourselves. Emotion is every investor's worst enemy, and I don't care how long you've been in crypto, I don't care how much you've invested, you will get these thoughts of, what if I would have invested more? Or this project is soaring up by 20%, maybe I should buy in. And it's okay to have these thoughts, but it's critical to not act on them, which is why it's imperative that we have these rules that we will not deviate from. And on the other side of the coin, those emotions can also lead you to selling something when you probably shouldn't have sold as well. That's why you hear everyone say all the time, only invest what you're willing to lose. So that way you're not as emotional when these volatile markets are going up by 30%, but also down by 30%. Don't be like me in 2017 when I put $2,000 out of the $8,000 that I had in my bank account into a project. And yes, I did luck out. That $2,000 ended up soaring to above $80,000, but it could have easily gone the other way. And I ended up actually paying for that in other ways down the road. You will get burned if you continually make the same mistake. You may win once, but it doesn't mean you'll win all the time. But even if you can battle emotions, it doesn't account for timing. So when is the right time to actually buy crypto? I have one rule for purchasing crypto that even surpasses that of dollar cost averaging, and that is I only buy crypto when the entire market is double-digit red, and I never buy crypto when the market is double-digit green. And you can quickly check this by going over to CoinMarketCap, and you can see how much the market has increased or decreased in a given time frame. And what happens here is usually something external will trigger a massive sell-off. And the great thing about buying crypto when everything is minus 20 to 30% off is that even if the market is headed in a downward trajectory, you can buy at these prices, and 99% of the time they will go back up at least 10 or 15%. So if you did want to sell, you could, but even more importantly are the benefits that you get for long-term accumulation. So let's say there's a crypto that I'm looking at that's at $5 and the market tanks and everybody's scared and everything is down by 20%. Well, that means that $5 coin is now at $4. And if I pick this up here, if I put $1,000 in and this project goes up to $30 come the next bull run, that $1,000 investment is now $7,500. But if I would have put $1,000 in at that $5 price point, that would only be worth $5,000. So that is a $2,500 swing just by waiting on a day when the market is double-digit red. And this can also play into your favor as well in the case of losses, because losses are okay and essentially it's just a part of the game in crypto, but it's imperative that we understand the rule of Pareto's principle and how it applies to crypto investing. And in summary, most of our investments won't have to be successful to make a life-changing amount of money. First, I'm going to go on the record and say this unpopular opinion. If you have less than $10,000 to invest in crypto, you should not be buying Bitcoin unless $10,000 turning to $30,000 is a life-changing amount of money. Because let's not kid ourselves, the only reason any of us are investing in crypto is because it is the vehicle to potentially make a life-changing amount of money. And if we want to turn $10,000 to $30,000, I can list a dozen ways right now that anyone can do that. Now, that being said, diversing into other crypto projects that are smaller in Bitcoin come with more risk. That's why there's more reward. But there's this book called Angel by Jason Calloway, an angel investor. And this is all really crypto investing is. It's angel investing for the regular person. In order to angel invest into actual companies like Uber or Tesla or anything like that, you have to be an accredited investor where you've made at least $200,000 over the course of 2 years, or you have a net worth of over $1 million. But with crypto, you don't have to worry about that at all. You could have literally $50 and you could turn that $50 into $50,000. Now, it's extremely unlikely, but the possibility is there. Now, that being said, 60% of all angel investors' investments don't end up working out. And then there's about another 20 to 30% where you end up really just breaking even. But it's the 10 to 20% that end up making up for all of your losses that make that life-changing amount of money. And this is what the Pareto principle says. It says that 80% of all of your gains will come from 20% of your investments. But that 20% of our portfolio that ends up creating that life-changing money won't end up coming to fruition if we don't have a rule of knowing when to exit our positions and when to actually sell. The last thing you want to do is end up doing all of this hard work and then you end up holding and never selling your position. This is something that the Dogecoin millionaire ended up doing, where he ended up turning around $20,000 to $30,000 to over $3 million at one point, and he never ended up selling. The real reason, when you boil this down, it roots into pure greed, because not only are you going to be losing out on the money that you could take out of that investment, but there's going to be an opportunity cost attached to that money where you could end up making even more money if you would have just pulled it out and have it work for you every month in different investment vehicles or creating new businesses or whatever that you want to do. And this is something that I've been guilty of as well, where I could have made easily 6 figures more in crypto if I would have just sold a little sooner. So no one can time the market, but the saying goes, when you ask a wealthy investor at how they got rich, they say, I sold too early. So it's better to take some profits than not at all. But that still doesn't answer the question of knowing, when do you actually take profits? My plan is looking at a variety of factors depending on where we are in the next bull run. So Bitcoin bull runs are heavily dependent upon the Bitcoin halvings, where the supply is halved every 4 years. And usually the bull runs start about 6 months after that halving. So I'm going to ask myself, well, where are we at in that process? Another question that I'm going to be asking myself is, how much has my original investment increased, and what are the current competitors in the market doing as well? Because if my original investment has already 20x'd, I'm taking out at least half of my funds, probably closer to 75%, and I'll let the other 25% ride in case it decides to move up anymore. But at that point, I'm psychologically detached and I've already taken out a lot of the funds. But probably the biggest factor that I've taken away of knowing when to sell across 2 bull runs is just being hyper aware of everyone around you, or the other 99%. One canary in the mine, so to speak, is when everyone starts asking you about crypto, because you're probably pretty knowledgeable and you probably watch videos like these. That's usually a good sign that we are at the peak of a bull run. But an easier way to do this is just to go into Google Trends, type in crypto or Bitcoin or very broad blockchain words, and see the spike and where it started to spike. And you're probably going to see spikes around December of 2017 and sometime in early and late 2021. And that's probably a good time where you're going to want to sell. And if you actually want to see what I'm investing in and how I'm putting this to work in my portfolio, check out this video right here.